What is bookkeeping and why it matters? Bookkeeping tracks all the financial transactions of a business, every bit of money that comes in, like sales, and every bit that goes out, like payments for rent, bills, and other expenses. It helps us see clearly how the business is performing and where the money is going. For example, a coffee shop records its sales as revenue. It also pays for rent, utility bills, staff wages and salaries, business insurance, and other daily expenses. The coffee shop owns assets such as cash, property, plant and equipment, and furniture and fixtures. It may also owe money, for example, bank loans, taxes, or unpaid bills. Also, the coffee shop has the owner's share of the business, which is money invested by the owner, plus profits kept in the business. Bookkeeping and accounting. They sound similar, right? But they actually do two different jobs, and both are equally important. Bookkeeping is all about collecting and recording financial data, basically keeping a detailed record of everything that happens in the business financially. So every time the business earns money, pays bills, buys stock, or spends cash, the bookkeeper writes it down. Think of them as the record keepers. They make sure every transaction is captured accurately and in order. Once all that data has been recorded, the accountant analyses and interprets it to make sense of the numbers. They look at the records, prepare financial statements like the profit and loss account and balance sheet, and then use that information to help make decisions. Together, they give us the complete financial picture of the business. In other words, they answer the question, what do these numbers actually tell us about the business? In business, transactions are classed as cash or credit depending on when payment takes place. Cash sale occurs when a business provides goods or services and receives the money straight away. For example, a customer pays instantly using a debit or credit card, bank transfer, or cash at the till. Credit sale takes place when a business supplies goods or services but allows the customer time to pay. The payment is made after an agreed period, such as 30 days. For example, sending an invoice that gives the customer 30 days to settle. Cash purchase happens when a business buys goods or services and settles the amount immediately. For example, paying for supplies in cash at the point of purchase. Credit purchase occurs a business receives goods or services from a supplier and agrees to pay at a later date. Example, receiving materials now and paying the supplier's invoice 30 days later. When running a business, there are two key groups you'll deal with every day: customers and suppliers. Customers are the people or other businesses who purchase your goods or services. Some customers pay right away. These are called cash customers. Others might be given a bit of time to pay. These are known as credit customers. For example, imagine a company selling office furniture. If someone walks into the shop, pays by card and takes their desk home, that's a cash customer. But if a company places a bulk order and is given 30 days to pay the invoice, that's a credit customer. Now, let's look at suppliers. Suppliers are the people or businesses that provide goods or services to your company. Some suppliers require payment right away. We call them cash suppliers, while others allow you to pay after a certain period, called credit suppliers. For instance, if you buy printer paper from a local store and pay at the counter, that's a cash supplier. But if you order office equipment from a wholesaler and agree to pay next month, that's a credit supplier. So, in short, customers bring money into the business. Suppliers are the ones the business spends money on. Every business stands in the middle of two flows: money coming in from customers and money going out to suppliers. These are called receivables and payables. Receivables represent the amounts that customers still need to pay the business for goods or services they've received on credit. Think of it like this. When your business makes a credit sale, you've earned income, but haven't yet received the cash. The customer now owes you, so the business records this as receivables. Imagine your business sold 50 bike helmets to a retailer with 30-day payment terms. Until they pay the invoice, that amount is part of your receivables, money you expect to come in soon. On the other side, we have payables. This refers to the money that the business itself owes to its suppliers for goods or services bought on credit. When a company makes a credit purchase, it receives the goods first and agrees to pay later. The supplier becomes one of the business's creditors because the business has an obligation to pay them. These amounts are recorded in the purchases ledger, which tracks each supplier, the amount owed, and the agreed payment date. For example, your company buys new bike parts from a wholesaler on 30-day credit terms. Until that invoice is paid, the balance appears in your payables, money due to go out in the future. In every business, transactions don't just happen. They're recorded, verified, and supported by documents. These documents create a paper or digital trail that shows what was agreed between the buyer and the seller. They confirm what was ordered, delivered, and paid for, and help both sides track progress, check accuracy, and sort out any issues if something goes wrong. The purpose behind them is to keep transactions transparent, accurate, and traceable. Let's look at the main documents used when businesses buy and sell goods or services. A price quotation is usually the starting point in a sale. It's a document prepared by the seller that lists the items or services offered, along with the prices, terms, and conditions. It gives the buyer an idea of how much something will cost before they decide to place an order. Purchase order. Once the buyer decides to go ahead, they send a purchase order to the seller. This document confirms what goods or services are being ordered, the quantity, and sometimes the agreed price. The invoice comes from the seller once the goods or services have been provided. It's an official request for payment and includes details such as what was sold, the date, the total amount, and when payment is due. The invoice forms a key part of a company's accounting records because it shows what income is expected. Goods received note GRN. When the buyer receives the goods, they issue a goods received note, often called a GRN. This document confirms that the items ordered have arrived and are in good condition. It's used to check that what was delivered matches the purchase order and that nothing is missing or damaged. Credit note. Sometimes mistakes happen. Maybe the wrong goods were delivered or some items were damaged. In such cases, the seller issues a credit note. A credit note reduces the amount owed by the buyer, correcting the original invoice. It's a way to show that the seller has accepted the return or the adjustment. Remittance advice. When the buyer makes a payment, they often send a remittance advice. This document tells the seller which invoices are being paid and the amount of each payment. It helps the seller match incoming payments to the correct invoices, especially when there are multiple transactions. Cash receipt. Finally, when payment has been received, the seller provides a cash receipt. This is proof of payment. It shows that the money has been received and the transaction is complete. Cash receipts are important for both the buyer and the seller's accounting records. In this lesson, we're going to look at really important accounting terms: assets, liabilities, equity, revenue, and expenses. Let's start with assets. These are things the business owns, like cash in the bank, property, computers, or equipment. Basically, anything that has value and helps the business run. Next, we have liabilities. These are the things the business owes. Money that needs to be paid back. It could be loans, unpaid bills, or credit card balances. Capital, also called equity, is the owner's stake in the business. It shows how much of the business the owner actually owns after adding what they put in and subtracting what they take out. There are two main parts. First, owner's investment. This is the money or assets the owner puts into the business to get it started or help it grow. And second, profits kept in the business. When the business earns a profit and the owner leaves some of it in the business instead of taking it out, that increases equity. Then we come to revenue. This is money coming into the business, usually from selling goods or providing services. In the UK, sales, revenue and turnover all refer to the money a business earns from its normal trading activities. In accounting, we usually use the word revenue. And finally, expenses. These are the costs of running the business. Things like rent, utilities, cleaning, insurance, staff wages and salaries, and so on. By keeping track of these categories, what the business owns, owes, earns, and spends, we can clearly see how the business is doing. On the balance sheet, there are 4 very important groups of items we always look at: current assets, non-current assets, current liabilities, and non-current liabilities. These 4 sections show us what the business owns and owes, and whether those things relate to the short term or the long term. In this session, we're going to look at each of these areas one by one, starting with current assets. Current assets are resources the business expects to turn into cash, sell, or use up within the next 12 months, or within the business's normal operating cycle, whichever is longer. They are important because they show the business's short-term financial strength, basically how easily the business can pay its immediate bills and operate day to day. Typical examples of current assets include cash and bank balances, amounts owed by customers, which we call trade receivables, stock or inventory, any prepaid expenses, and short-term investments, which we expect to convert into cash within a year. So when we talk about current assets, we're really talking about the liquid part of the balance sheet, the part that supports the everyday running of the business. Cash, cash equivalents and bank balances include physical cash and money in business bank accounts, as well as cash equivalents, which are highly liquid, short-term investments that can easily be turned into cash. Trade receivables are amounts owed to the business by customers who have bought goods or services on credit. We expect to receive this money within the next 12 months or within the operating cycle. Prepayments are costs the business has recognised or paid before the end of the period, but it relates to a future period. Because the benefit is expected to be received later, it is shown as a current asset until that future period arrives. Inventory or stock are goods the business owns with the intention of selling or using in the production of goods or services. We expect to sell or use the stock as part of the normal operating cycle. Short-term investments are investments the business plans to convert into cash within the next 12 months or within the operating cycle. They are temporary investments held for the short term. So all of these items are part of current assets because they will be realised, sold or used within a relatively short period of time. They help the business operate smoothly and meet short-term financial commitments. Non-current assets are resources that a business intends to use for more than one financial year. Rather than being sold or turned into cash quickly, these assets support the long-term operations of the business. They include items such as tangible fixed assets like property and buildings, plant and machinery, vehicles, office equipment, and intangible fixed assets like software, licenses, trademarks, patents, and goodwill. The key point is that non-current assets provide economic benefit over several accounting periods, rather than just the current one. They help the business generate income in the long term and are therefore reported separately from current assets in the Statement of Financial Position. Overall, non-current assets reflect the long-term investment and value held by the business rather than short-term working capital. Property, plant and equipment are physical assets used to run the business, such as land, buildings, machinery and vehicles. They are held for long-term use rather than resale. They are depreciated over its useful life, with the exception of land which is not normally depreciated. Intangible assets are non-physical assets that still provide value to the business. Examples include computer software, licenses, patents, trademarks, and goodwill. Many intangible assets are amortized over their useful life, meaning the cost is spread over the period in which the business benefits from them. Investment property is property that the business holds to earn rental income or for long-term value growth, rather than for its own use. Investment property is treated as a non-current asset because the intention is to hold it over several periods rather than sell it in the short term. Long-term investments are investments that the business plans to hold for more than 1 year. They might include shares, bonds, or deposits that are not expected to be converted into cash in the near future. Because the intention is long-term holding, they are shown as non-current assets. Other long-term assets, such as long-term loans receivable or long-term deposits. These are also included as non-current assets because they will provide benefit over a longer period of time. So overall, non-current assets represent the long-term resources of the business. They help generate income over several periods and therefore are reported separately from current assets, which relate to short-term activity. Understanding this difference is important when analysing how a business is structured and how it plans for the future. In accounting, a current liability is a business debt or obligation that must be paid within the next 12 months. Current liabilities are short-term debts the business needs to settle in the coming year. Trade payables are amounts the business owes to suppliers for goods or services bought on credit. Bank overdraft is when the business bank account has gone below zero, the amount owed to the bank is a current liability. This is usually repayable on demand and often incur interest. Accruals are expenses that the business has used or incurred in the current period, but the invoice or payment will happen later. Payroll taxes owed is when employees receive wages, payroll tax deductions are taken out and must be paid to the government shortly after. Until paid, those amounts are a liability. Wages and salaries owed. When employees have earned wages but payday hasn't arrived yet, the amounts owed become a liability at the end of the accounting period. Short-term loans and the current portion of long-term loans must be repaid in the next 12 months is a current liability. Even if the loan lasts several years, the next year's instalments are treated as current. Unearned or deferred revenue is the revenue that has been invoiced or paid by customer, but the business has not yet delivered the goods or services. Non-current liabilities are amounts the business owes that are not due for payment within the next 12 months. These are long-term debts and obligations. They also affect how lenders and investors view the financial strength of a business. Main types of non-current liabilities are long-term loans. These are loans or borrowings that won't be paid back within the next 12 months. Next are loan notes, bonds, and debentures. Some companies raise finance by issuing loan notes or bonds to investors. These are usually repayable after several years. They are basically long-term borrowing from investors rather than banks. Finance lease liabilities. When a business uses assets through a finance lease, part of the lease payments will fall due beyond the next year. That longer-term portion is a non-current liability. Provisions, their long-term part, is a liability where the amount or the timing is uncertain. If the obligation won't be settled for more than a year, it is treated as a non-current liability. Current assets and current liabilities are short-term. They are within the next year. Non-current assets and non-current liabilities relate to the longer term, more than 1 year. Assets are what the business has, and liabilities are what the business owes. That structure helps us clearly see the financial position of the business. Every business tells a story, and that story is written in numbers. In this lesson, we're going to learn one of the most important stories, how a business earns a profit or makes a loss. Your revenue is the amount a business earns from selling its goods or services, even if the customer pays at a later date. Expenses are the costs a business has to pay in order to run and operate. If the business earns more than it spends on its running costs, the difference is a profit. But if the running costs are higher than what the business earns, that difference becomes a loss. Here's a bakery that sold bread worth £1,000. That's their revenue. They spent £700 on flour, rent and wages. Those are expenses. So £1,000 minus £700 equals £300. That's their profit. Now look at this case. They earned only £600, but their expenses were £800. So £600 minus £800 gives us minus £200. That's a loss. They spent more than they earned. This is exactly what happens in every business, from a small cafe to a big company. Profit arises when revenue exceeds the costs required to run the business. When the cost is greater than the revenue generated, the business reports a loss. So remember, profit isn't just a lucky number. It tells you how well the business is being managed. One last thing, a business can make money from other small sources, like interest, rental income, profit from selling equipment. These are called other income, and they also increase profit. Now we are going to look at the layout of a profit and loss statement, also called an income statement. The statement always has a heading which shows the name of the report and the accounting period. For example, income statement for the year ended 31st December 2025. We start at the top with revenue, also called turnover. That is the total sales the business has made during the period. Next, we deduct what is called cost of sales, sometimes known as cost of goods sold. This represents the direct cost of the products we have sold, such as direct labour or used materials. When we deduct cost of sales from revenue, we arrive at the first key result, which is gross profit. Gross profit shows how much profit the business has made after covering the direct costs of making or buying the goods that were sold. Under the gross profit line, we then deduct operating expenses. These can be split into headings: administrative expenses, for example, office costs, insurance, administration staff wages, and general overheads. Distribution and selling costs, for example, delivery, advertising, marketing, or sales team expenses. When we deduct these operational expenses, we arrive at operating profit. This is a very important figure because it shows how profitable the business is from its core activities before considering things like interest or tax. Below operating profit, we add other income. Other income is money earned from activities that are not part of the main business, such as interest received. Then we subtract finance costs, which usually means interest expense on loans or overdrafts. After these items, we reach profit before tax. That is the profit before the business pays corporation tax. Finally, we deduct taxation. And the result is profit or loss for the year. This is the final bottom line figure that shows how much profit or loss the business has earned after all expenses and tax. In this lesson, we're going to look at owner's capital and the balance sheet basics. Let's start with something simple. Imagine you're starting your own small bakery. You put in £3,000 of your own money to buy equipment and ingredients. That money you invested is called owner's capital. It's the amount the owner puts into the business to get it started or keep it running. Now, as soon as the business starts, we can describe what it owns and what it owes. That's where the balance sheet comes in. The balance sheet shows three things: what the business owns, called assets, what it owes, called liabilities, and the part that belongs to the owner. That's the owner's capital. These three always stay in balance, and we show it as a simple equation. Assets equals liabilities plus owner's capital. For example, if your bakery owns £5,000 worth of assets and owes £2,000 in loans, the remaining £3,000 belongs to the owner. That's your capital. So remember, the balance sheet is called a balance sheet because both sides always have to equal each other. It's like a set of scales. When one side changes, something must change on the other side too. Now we are going to look at the balance sheet layout prepared in accordance with Financial Reporting Standard 102, which is also called the Statement of Financial Position. This statement shows the financial position of a business at a particular point in time, usually at the end of the financial year. Unlike the profit and loss statement, which covers a period of time, the balance sheet shows what the business owns and owes on a specific date. At the top of the statement, we list fixed assets, also known as non-current assets, which are long-term items such as equipment, buildings, or machinery. These are assets the business uses for more than 1 year. Debtors falling due after more than 1 year is non-current asset. Secondly, we have current assets, which are short-term items that we expect to turn into cash within 12 months. Current assets include inventory, trade receivables, and cash. When we add non-current, current assets, and current liabilities together, we get total assets less current liabilities. Non-current liabilities are long-term obligations such as bank loans. When we deduct creditors falling due after more than 1 year, we get net assets. Below net assets, we show equity. Equity represents the owner's interest in the business. For a company, this usually includes share capital, reserves, and retained earnings. Retained earnings are the profits kept in the business rather than paid out as dividends. Share capital is the money that shareholders have invested in the company by buying shares. So it represents the owner's original investment into the business. This equality is based on the fundamental accounting equation: assets equals equity plus liabilities. This is why it is called a balance sheet, because it must always balance. The accounting equation is the foundation of all bookkeeping. It shows that everything a business owns, assets, is financed by either what it owes, liabilities, or what the owner invested, owner's capital. Accounting equation formula: assets equals liabilities plus owner's capital. This means the two sides of the equation must always stay in balance. Let's say the owner puts £5,000 of their own money into the business. What happens? The business receives cash, so assets go up by £5,000. At the same time, the owner's investment increases, so capital goes up by £5,000. See, both sides of the equation increased equally. Next, imagine the business buys a computer worth £1,000 but doesn't pay immediately. The business now owns a new asset, the computer. So assets go up by £1,000, but it also owes £1,000 to the supplier. So liabilities go up by the same amount. The equation still balances. Now, the business pays off £500 from a loan. That means cash goes down. So assets decrease by £500. The amount owed also goes down. So liabilities decrease by £500. Again, both sides fall equally, and the balance is maintained. Next, the business earns £2,000 from sales. That means cash increases. Assets go up by £2,000. At the same time, profit increases the owner's share. So capital goes up by £2,000. The business is growing, but the balance still holds true. Finally, the business pays £300 for rent. Cash decreases, so assets go down by £300. That rent is an expense, which reduces profit. So capital goes down by £300. Both sides decrease, and the equation stays equal. So in every example, something goes up and something else goes down. That's why the accounting equation always stays balanced. Every transaction affects two accounts, but the total always matches. That's the magic of double-entry bookkeeping. In an accounting system, financial information isn't all recorded in one place. Transactions are stored in different books or records, depending on their type and purpose. We call these transaction locations. Let's look at the main ones you'll encounter. Books of prime entry. These are the first records in which a transaction is written down, the starting point of the bookkeeping process. Examples include Sales Daybook for credit sales, Sales Returns Daybook, records goods returned by customers, also called returns inwards, Purchases Daybook for credit purchases. Purchases returns daybook records goods returned to suppliers, also called returns outwards. And cash book for cash receipts and payments. Here we have an example of a sales day book which records all goods and services sold on credit to our customers. Each line shows a separate sale during the month. For example, on the 4th of January, the business sold goods to Bright Home Interiors for £850 net, plus £170 value-added tax, making a total of £1,020. Now, let's look at the Purchases Daybook, which records everything the business bought on credit from its suppliers. On the 3rd of January, for instance, the company purchased office supplies from Office Pro Supplies for £620 net plus £124 value-added tax, giving a total of £744. Here's a summary overview of the main books of prime entry used in bookkeeping. The Sales Day Book records all credit sales made to customers. The Purchases Day Book records all credit purchases made from suppliers. The Sales Returns Day Book records goods returned by customers. The Purchases Returns Day Book records goods returned to suppliers. And finally, the Cash Book records all receipts and payments made by the business. This includes both cash and bank transactions. Now that we've looked at the daybooks or books of prime entry, such as the Sales Daybook, Purchases Daybook, and the Cash Book, we're ready to move into the next stage of bookkeeping, the General Ledger. This is where transactions are summarized and categorized to show the financial position of the business. The General Ledger is the central record of all financial transactions. It includes assets, liability, equity, revenue, and expense accounts. Think of it as the master book that contains a summary of all financial activity. The General Ledger forms the basis for preparing the trial balance and eventually the profit and loss account and balance sheet. Subledgers, also called subsidiary ledgers, keep the detailed transactions for specific accounts. They support the General Ledger by showing how each total is made up. The Sales Ledger shows each customer and what they owe. The Purchase Ledger shows each supplier and what we owe them. The General Ledger holds the totals, and these subledgers hold the details. Prime entry books are Cash Book and Petty Cash Book. The Cash Book records all cash received and spent, and the Petty Cash Book records small day-to-day cash expenses. The Receivables Ledger, called the Sales Ledger, keeps track of money owed to the business by its customers. Each customer has their own individual account. Whenever goods or services are sold on credit, that transaction is posted here. When customers make payments, their accounts are updated to reduce the balance owed. In summary, it shows who owes the business money and how much. The Payables Ledger, also known as the Purchase Ledger, is the opposite of the Receivables Ledger. It records money that the business owes to its suppliers. Each supplier has an individual account. When the business buys goods or services on credit, the amount is recorded here. When payments are made to suppliers, the balances are reduced. This helps the business manage its liabilities and cash flow effectively. The Cash Book records all money received and paid out of the business, whether through physical cash or through the bank. It often serves a dual role. It acts as a book of prime entry, where transactions are first recorded, and it also functions as part of the ledger system because it contains the actual cash and bank accounts. You'll usually see two main columns: receipts, debits, showing money coming in, and payments, credits, showing money going out. The Petty Cash Book is used for recording small, everyday payments, such as postage, stationery, or minor office supplies. It's controlled by a system known as imprest, where a fixed amount is kept in hand. When small expenses are paid out, the total is reimbursed to bring the balance back to the original imprest amount. This makes it easy to monitor and control small cash transactions. Let's move on to one of the most important accuracy checks in bookkeeping, bank reconciliation. Bank reconciliation is simply the process of comparing the business's cash book, our internal record of bank transactions, with the bank statement provided by the bank. We do this to make sure both records show the same balance. Why is this necessary? Because timing differences and errors can easily occur. The bank may record something before or after we do, or we might have missed a transaction altogether. The main purposes are to spot timing differences or errors, to confirm the real balance available in the bank, and to detect fraud or missed entries before they become bigger issues. It's completely normal for the cash book and bank statement not to match exactly at first. There are many legitimate reasons for this, and understanding them helps you reconcile accurately. Common reasons include: first, outstanding checks. These are checks we've written and recorded, but the bank hasn't cleared them yet. Until the supplier cashes them, they don't appear on the bank statement. Second, deposits in transit. That's money we've received and recorded, but the bank hasn't processed it yet. Third, bank charges. The bank may deduct service fees automatically, and we only find out when the statement arrives. Fourth, standing orders or direct debits. They are automatic payments that the bank processes but haven't yet been entered in our cash book. Now that we understand the basic idea of bank reconciliation, let's look at how this works in real life, using an actual bank statement and our own accounting records. We're going to look at the transactions from two different viewpoints, the bank's and ours. On the left-hand side, we have the bank statement. This is the record prepared by the bank, not by the business. The bank statement shows an opening balance, a list of transactions, and a closing balance at the end of the period. The paid-in column shows money coming into the bank account. This could be customer payments received, cash deposits, or transfers received. When money is paid in, the bank balance increases. The withdrawn column shows money leaving the bank account. These are payments the bank has made on behalf of the business. When money is withdrawn, the bank balance decreases. Not all banks present statements in the same way. Some banks use paid in and withdrawn, some use debit and credit, some use plus and minus signs. Regardless of the layout, the meaning is always the same. Money in increases the balance, money out reduces the balance. If a bank uses debit and credit labels, remember, credit means money into our account, debit means money out of our account. That's because the statement is written from the bank's perspective, not ours. Now let's look at the right-hand side, which shows our general ledger, cash at bank. Cash at bank is an asset. Assets increase on the debit side and decrease on the credit side. When we receive money, such as the £1,000 from our customer West Limited, our bank balance increases. Because our asset increases, we record this on the debit side of the cash at bank account. When we make payments such as rent, utilities, or card payments, cash leaves the business. We record these on the credit side. At the end of the period, the bank statement shows a closing balance of £1,400. Our cash at bank account also shows a closing balance of £1,400. Our cash at bank balance reconciles to the bank statement balance. Let's now look at a different situation. We have received the bank statement for the period, and when we compare it to our cash at bank account in the general ledger, we can see that the two balances do not agree. We must update the cash at bank account for items that appear on the bank statement but are missing from our records. Looking at the bank statement, we can see several transactions that do not appear in our cash at bank account, a direct debit for broadband, bank charges, and a customer receipt. We update the cash at bank account for these transactions shown on the bank statement that we have not yet recorded. The cash at bank ledger must be adjusted for all bank statement items not yet recorded in order for the balances to reconcile. Once these entries have been posted, the cash at bank account is fully updated and reflects the true cash position. The balancing figure, balance carried down, is written on the credit side to make the totals match. Now let's look at the opposite situation, where transactions appear in our cash at bank account but do not yet appear on the bank statement. This usually happens because of timing differences. We record a transaction as soon as we issue a check to supplier or receive cash or check from customer, but the bank will only record it once it is processed. So our books can sometimes be ahead of the bank. In our case, we issued a check to supplier which hasn't been processed by the bank yet, and we recorded a check which we received from our customer but hasn't been processed by the bank yet. These items do not appear on the bank statement yet. Transactions recorded in the cash at bank account but not yet shown on the bank statement are not adjusted in the ledger. We do not change the cash book for timing differences. This rule is critical. Instead of posting journals, we include these items in the bank reconciliation statement. Unpresented checks are added back in the bank reconciliation statement, and deposits in transit are deducted. After these adjustments, the balance should agree to the bank statement closing balance. Once the bank processes these items, they will automatically appear on the next bank statement and the difference will disappear. Now let's look at a dishonoured check, which is treated differently from timing differences. A dishonoured check occurs when a customer pays us by check. We record it as received, but the bank later rejects the check. This can happen due to insufficient funds, a cancelled check, or an error on the check. When the check is dishonoured, it means the cash was never actually received, so the original entry we made in the cash at bank account is incorrect. Initially, when we received the check, we debited the cash at bank account and credited the trade receivables. When the check is dishonoured, the bank removes the money from the account and we must reverse the original receipt. To correct this, we credit the cash at bank account and debit trade receivables. Let's summarise. When we compare the bank statement to our cash at bank account, every difference we find will fall into one of three categories. If a transaction appears on the bank statement but does not appear in our cash at bank account, this means the bank knows about the transaction, but we do not. Because this represents a real movement of cash, we must record it in our books. We post these items to the cash at bank account. Examples are bank charges, direct debits, standing orders, and interest received. If a transaction appears in our cash at bank account but does not yet appear on the bank statement, this is usually a timing difference. We have already recorded the transaction correctly, but the bank has not processed it yet. In this case, we do not post anything further to the cash book. Instead, we explain the difference in the bank reconciliation statement. Examples are outstanding checks and deposits in transit. Dishonoured checks are different from a timing difference. We originally believed check had been received and recorded it in our books, but the bank has rejected the check. This means the cash from our customer was never actually received. As a result, our original entry must be reversed. We reverse the original receipt by crediting the cash at bank account and debiting trade receivables. Dishonoured checks are not timing differences. Here's the step-by-step method you'll use when preparing a bank reconciliation. Step 1. Compare the entries in the cash book and the bank statement line by line. Step 2. Tick off all the matching transactions. Step 3. Highlight anything that doesn't match or is missing. Step 4. Make adjustments in the cash book for any items not yet recorded, such as bank charges or direct debits. Step 5. Prepare the reconciliation statement showing how the cash book balance and the bank statement balance line up. And finally, Step 6. Make sure that after all adjustments, both balances agree. It's a very logical process. Once you practice a few times, you'll find it becomes second nature. Now, even though the process is straightforward, there are some common mistakes that can cause major confusion. For example, double entry mistakes, where a transaction is entered twice, or reversal errors, where debits and credits are swapped. Sometimes people record payments or receipts on the wrong date, which makes matching difficult. Other common issues include missing standing orders or using the wrong bank statement for the period you're reconciling. To avoid these, always cross-check your figures against the source documents, invoices, receipts, and statements. In reconciliation, accuracy matters. Small errors can ripple through the entire bookkeeping process. Finally, let's talk about why reconciliation is so valuable to a business. First, it helps detect fraud or unauthorized payments. You'll notice immediately if money has left the account unexpectedly. Second, it confirms the accuracy of your cash book. Third, it ensures the business always knows its true bank position, not just what's on paper. And finally, it builds confidence in your financial reporting. So, to summarize, bank reconciliation is not just an administrative task. It's a vital control that ensures trust, transparency, and accuracy in the accounting process. Every organisation, no matter how big or small, needs to move money in and out, paying suppliers, receiving money from customers, or handling regular expenses. So when we say payment methods, we simply mean the different options available for making or receiving those payments. Let's go through the main ones you'll come across in bookkeeping. The most traditional method, physical coins and notes. It's simple and instant, but not ideal for large transactions or detailed records. So, cash is often used for small or local purchases. A cheque is a written instruction to a bank, telling it to pay a specific amount to someone. Although it's not as common today, some traditional businesses still use cheques, especially for supplier payments. Debit card is an electronic payment taken directly from a bank account. It's quick, convenient, and ideal for everyday business transactions or purchases. Credit card is used to borrow the money from the bank and then repaying it later. It's great for managing short-term cash flow. For example, paying for travel or online subscriptions. Bank transfer means transferring funds electronically from one bank account to another. For example, paying a supplier invoice. Bank transfers are fast, reliable, and leave a clear record of each transaction. In the UK, bank transfers can move over different systems. The main ones are faster payments, usually instant, seconds to 2 hours, ideal for day-to-day transfers. BACS takes about 3 working days, great for payroll and bulk or regular payments at low cost. CHAPS are same day for high-value, urgent payments. Fees apply, used for large urgent business transfers. Standing order is a fixed payment set up by the business. The same amount paid on a regular schedule, like rent or loan repayments. It's controlled by the payer and it continues until it's cancelled. Direct debit is controlled by the receiver. The receiver decides when to collect payments, which is perfect for variable amounts like utility bills or subscriptions. Online payments like PayPal and Stripe are online payment systems. These are digital platforms that make it easier for customers to pay instantly online. They're perfect for e-commerce and freelancers because they're quick, secure, and widely accepted worldwide. So, those are the main payment methods businesses use. Each one has its pros and cons, and the best choice depends on what's being paid for and how the business operates. Now that we've covered the types of payment methods, let's look at how to choose the right one. There's no one-size-fits-all solution. Businesses need to think about several factors before deciding which method to use. First, cost. Every payment method has a price. Bank transfers or card payments may include fees, while cash can cost time to manage and deposit. Next, speed. How quickly the money moves. Card and online payments are instant, but BACS bank transfers or cheques can take several days. Then, security. Some methods are safer than others. Electronic and direct debit payments are more secure than handling large amounts of cash. Record keeping is also key. Bank transfers and cards leave an automatic trail, which makes bookkeeping easier. Cash, however, requires manual tracking. Finally, suitability. Not every method fits every situation. A retail shop might prefer card payments because they're fast and convenient for customers, but a supplier might prefer a bank transfer because it's traceable and easy to reconcile. Every transaction in business has 2 sides. In accounting, we record both sides so that our books always stay in balance. This method is called double entry bookkeeping because each transaction is entered twice, once as a debit and once as a credit. A ledger account is shaped like a T. The left-hand side is for debits, the right-hand side for credits. Think of the debit side as what the business owns or spends, and the credit side as what the business owes or gives away. This keeps the accounting equation in balance. Assets equals liabilities plus capital. Let's take an example. The business buys a computer for £500 cash. Now, what's happening here? The business is getting a computer, which is an asset. When an asset increases, we debit that account. So we record debit equipment account £500 because our equipment, or assets, have gone up. But at the same time, the business is paying cash. That means the cash the business owns is going down. When an asset decreases, we credit that account. So we record credit cash account £500 because the cash asset has reduced. Notice how one side increases and the other decreases, and the two amounts are the same. That's the key rule in double entry bookkeeping. Every transaction has two sides, and the total debits must always equal the total credits. You can see two T accounts side by side. On the equipment account, you write £500 on the left side, the debit side. On the cash account, you write £500 on the right side, the credit side. If you add up both sides, the total still balances. One debit, one credit, same amount. Paying utility bill increases expenses, debit expenses, and reduces the bank balance, credit bank. The business gains a new asset, office desk, so the asset account increases, debit. Bank, another asset, decreases, so it's credited. Drawings are money taken out by the owner. They reduce the owner's capital, so they are debited. The business takes loan from the bank. Liability increases, credit, and receives cash, asset increases, debit. Selling goods increases sales revenue, credit, and increases the bank balance, debit. The business receives money. Asset increases, debit bank, and the owner's investment increases capital, credit capital. To remember how each type of account behaves, it helps to understand what increases or decreases them. Debit side. Assets. When the business owns or receives something of value, we debit the asset account. Example, buying equipment or a vehicle. Expenses. When the business spends money or incurs a cost, we debit the expense account. Example, paying rent, wages, or electricity bills. Drawings. When the owner takes money or goods out of the business, we debit drawings because it reduces capital. Example, the owner withdraws £500 for personal use. Credit side. Revenue. When the business earns money from sales or services, we credit revenue count. Example, making a sale or earning service income. Liabilities. When the business owes money or takes on a debt, we credit the liability account. Example, taking out a loan or buying on credit. Capital, owner's equity. When the owner invests money into the business, we credit capital because it represents the owner's claim on the business. Example, the owner invests £2,000 to start the business. In summary, debit increases assets, expenses, drawings. Credit increases revenue, liabilities, capital. Remember, every debit must have an equal credit so that the books always stay in balance. What is account coding? Coding means assigning a unique number to each account in the chart of accounts. Think of it like a postcode system for your finances. Every account gets its own location number so it can be found, grouped, and summarized easily. These numbers are called account codes or nominal codes, and they make it much faster to enter transactions consistently, sort or filter accounts by type, and prepare financial statements automatically. Why coding is useful? Consistency. Everyone in the finance team uses the same numbering system, so for an example, code 6000 means wages, not something random. Speed. You can post transactions quickly without searching long account names. Reporting. Codes help your software instantly group totals for assets, liabilities, revenue, and expenses. For example, if all expense codes begin with 6, you can easily pull out all your costs by asking the system to total anything that starts with 6. In this table, we can see how each account in the business is given its own account code and category. For example, bank account has the code 1000, which falls under current assets, money the business owns. We use different code ranges for different types of accounts, assets and liabilities, both current and non-current, cost of sales and overheads for running costs, administrative expenses, revenue accounts, and owner's equity, which shows how much the owner has invested in the business. How it works in practice. Let's say we're recording a transaction for office rent. Instead of typing office rent expense every time, we can simply type code 7000. The system knows this means rent expense. If we then record utility expenses under 7,100 and insurance under 7,200, our software can easily produce a total for all accounts in the 7,000 to 7,999 range, which we know represents administrative costs. There's no legal rule saying your bank account must be 1,000 or your capital must be 3,000. These are just conventions, agreed upon structures that make it easier for accountants across businesses to read ledgers. A company might decide to start its sales at 4,000, while another might use 100 for the same purpose, and that's fine, as long as it's consistent throughout that system. In larger businesses, codes can have more detail. For an example, 7000-01 might mean office rent, London branch. 7000-02 could mean office rent, Manchester branch. The first part of the code shows the type of expense, and the second part identifies the department, project, or location. Before we look closely at the journal, let's take a step back and think about how most financial information enters a business's accounts. In everyday bookkeeping, the bulk of transactions flow naturally through the normal books. Sales go through the sales ledger, purchases go through the purchase ledger, money in and out goes through the cash book. Sometimes accountants discover that something was entered incorrectly, or a new business needs its opening balances recorded, and that's where the journal comes in. The journal acts as the system for recording opening balances, wages and salaries, error corrections, and bad debts. Think of the journal as the accountant's professional toolkit, the space where you can explain exactly what happened, record the debit and credit clearly. Journals are essential. Accountants make final adjustments for year-end accuracy. None of these cases can be handled through the normal ledgers. In a computerized system, you enter the journal once, then the system automatically updates all the ledgers for you. So even though the software hides the detail, the logic remains exactly the same. Now let's look at a real example of how we record opening balances using the journal. When a business begins a new accounting period, or when it first starts trading, we need to enter all the assets, liabilities, and capital that already exist on day one. The journal is the tool we use to do this, because opening balances don't come from invoices, receipts, or day-to-day transactions. They're non-routine entries. Let's walk through this example together. Now let's look inside the journal table. We have 3 key columns: account name of each ledger account, debit and credit. Remember, assets and expenses go on the debit side, liabilities, capital and income go on the credit side. Opening entries simply follow this rule. Here we see debits for bank £10,000 and £50,000, office equipment, VAT recoverable and office supplies. When we debit these accounts, we are saying the business owns these assets at the start of the period. So the company begins with cash in the bank, equipment, supplies and value-added tax owed to the business. These are all positive assets. On the credit side, we have owner's capital, bank loan, bank payments. Credits tell us the source of funds. The owner invested £10,000 into the business. The business owes £50,000 to the bank as a loan. So credits represent obligations, owner's investment, and movements of cash out. At the bottom of the table, we have total debits of £70,200 and total credits of £70,200. This is crucial. Every journal entry must balance. If the totals aren't equal, something has been entered incorrectly. Balance totals tell us the opening financial position is complete and accurate. By reading this journal entry, we can understand the opening financial position of ABC Limited. The business starts with £60,000 cash across various entries. It owns equipment and supplies. It has a bank loan. The owner has invested £10,000 and value-added tax is recoverable. Once the journal is complete, each line must be posted into its own ledger account. For example, the credit to owner's capital goes into the owner's capital account. This shows how much the owner invested in the business. The credit to bank loan goes into the loan account. This records the amount the business owes to the bank. The debit to office equipment goes into the office equipment account. This records the equipment the business owns as an asset. The debit to office supplies goes into the office supplies account. This shows the business starts with supplies on hand. The debit to VAT goes into the value-added tax on purchases account. This records VAT the business can reclaim. So the journal works like a master checklist. Why wages appear in the journal? Wages and salaries are one of the biggest expenses for most businesses. But wages aren't just one simple payment. They include gross wages. It's the full amount an employee earns before anything is taken off. This figure normally comes straight from the employee's contract. Gross wages are the starting point for all payroll calculations, not the amount the employee actually receives. Income tax. Income tax is a mandatory deduction taken from an employee's gross pay. The amount depends on how much the employee earns and the tax bands they fall into. This money doesn't stay with the business. It must be passed to HMRC. So although it reduces the employee's pay, it also creates a temporary liability for the employer until it's paid over. National insurance. National insurance is another deduction tied to earnings. There are two parts involved. Employee national insurance, it's taken from the employee's gross pay, and employer national insurance, it's an extra cost the business must pay on top of wages. This is an expense for the company. Both amounts eventually are paid to HMRC. Employee national insurance reduces the employee's income. Employer national insurance increases the business's cost. Pension contributions. Pension contributions help the employee save for retirement. They usually involve employee pension contribution, which is deducted from pay, and employer pension contribution, which is added cost for the employer. Both amounts go to the pension provider. Employee contributions reduce take-home pay. Employer contributions increase the business's total cost. Net wages are the take-home pay, the amount the employee actually receives into their bank account or in cash. It is calculated as gross wages minus income tax minus employee national insurance and any other deductions like pension. Net wages represent the actual payment the business makes to employees. Wages expense represents the full cost to the employer of having staff. It includes gross wages, employer's national insurance, and employer's pension contributions. These extra employer costs are not optional. They are required by law. Because wages include many small parts, they do not flow neatly through one ledger. That's why wages are treated as a non-regular transaction, recorded in the journal first. The journal helps us show all parts of the wages cost, clearly explain what's happening, link expenses, liabilities, and bank movements, and keep a full record that is easy for auditors or future bookkeepers to follow. To keep everything tidy, we use a wages control account, an account that temporarily collects all payroll entries before they are posted to the correct ledger accounts. After all postings are complete, the wages control account should balance to zero, confirming everything has been allocated correctly. Let's look at the payroll figures we'll be using for this month's example. A business has several key components that make up its payroll. First, we start with gross wages. That's the total pay that employees earn before any deductions. From this amount, we then apply the statutory deductions. The first major deduction is income tax. Next, we have employee national insurance, which is the employee's contribution. In addition to what employees pay, the employer also has obligations, so we include employer national insurance, which is the employer's cost, calculated separately from the employee's deduction. We also include pension contributions. There are two parts here: employee pension contributions, which come out of the employee's pay, and employer pension contributions, which the employer adds on top of the employee's wages. All of these figures together give us a full picture of the payroll costs for the business, the employee's take-home impact, and the employer's total payroll expense. These numbers will be used throughout the worked example so we can see clearly how payroll is recorded in the accounting system. Here's how the total wages expense is calculated step by step. The wages expense shows the true total cost of employing staff. It includes not only the gross wages, but also the additional costs the employer must cover. Start with the gross wages. This is the amount the employee earns before any deductions. Add the employer's national insurance contribution. Employers must pay national insurance on top of the employee's wages. Add the employer's pension contribution. Add all three together to get the full cost of employing staff. This gives total wages expense of £14,260. The total wages expense of £14,260 is subsequently posted to the wages control account to record the full cost of wages for the period. Let's talk about net wages, the amount employees actually take home. When an employee earns wages, the amount they see on their contract or payslip under gross wages is not what they actually receive in their bank account. Gross wages are the total earnings before any deductions are removed. To find net wages, we start with the gross wage figure and then subtract all the compulsory and voluntary deductions. In this example, the employee has gross wages £12,800. From this, we subtract several deductions. First, income tax £2,100. Second, employee national insurance £980. Third, employee pension contributions £600. When we subtract these amounts from the gross wage, we get net wages £9,120. This is the actual amount paid to the employee, their take-home pay. It's what arrives in their bank account after all legally required and agreed deductions have been made. Now, we must record the payment to employees in the accounts. When the business pays, the employee's money is leaving the business bank account, so we credit the bank account. This shows that £9,120 has been paid out to employees. At the same time, we need to reduce the amount we owe to employees. The wages control account originally held the net wages as a liability. To clear this liability, we debit the wages control account. This entry removes the amount owed to employees, showing that the wages have now been paid. Let's look at the HMRC liability created. This liability represents the total amount the business must pay over to HMRC after the payroll has been processed. We calculate it by adding together the income tax deducted from employees, the employee national insurance, and the employer national insurance. So here we take £2,100 for income tax, plus £980 for employee national insurance, plus £860 for employer national insurance. When we add these together, we get HMRC liability £3,940. Now that we've calculated the HMRC liability of £3,940, we need to record this properly in the accounts. When we create the HMRC liability, we are recognizing money that the business must pay to HMRC later. Here's how we post it. Credit HMRC liability account. This shows that £3,940 is now owed to HMRC, and debit wages control account to balance the double entry. Now let's look at the pension fund liability. This liability represents the total amount the company must pay over to the pension provider. It includes both the employees' and employers' contribution. In this case, we add employee pension contribution £600 and employer pension contribution £600, which gives us pension fund liability £1,200. This is the amount the business now owes to the pension provider following payroll. Once the total pension fund liability has been calculated, we need to record it correctly in the accounts. This amount represents money the business now owes to the pension provider. We credit the pension contribution liability account because this is a liability the company must pay, and debit the wages control account. Now let's summarize the full breakdown of the wages control account. The wages control account is used to gather all payroll-related amounts in one place. Let's break down how each part of the payroll flows through this account. First, we credit wages control account £14,260 and debit wages expense for the total payroll cost. Second, when employees receive their net pay, the business pays money out of the bank. So we debit the wages control account £9,120 to reduce what we owe to employees and credit the bank to show the payment has been made. This clears the net wages portion from the control account. Third, amounts owed to HMRC. We deal with income tax, employee and employer national insurance contributions, together totalling £3,940. These are liabilities owed to HMRC, so we transfer them to the HMRC liability account. Debit wages control account £3,940 and credit HMRC liability. Fourth, amounts owed to the pension fund. The employee and employer pension contributions, totalling £1,200, must be recorded as a liability to the pension provider. Debit wages control account £1,200 and credit pension contributions liability. If we add up all the debits and credits from the wages control postings, we see that total debits and credits equal £14,260. Because the totals match, the journal is perfectly balanced. Final summary. The wages control account works by holding all payroll-related amounts temporarily, clearing them out to the correct accounts, bank, HMRC, pension fund, ensuring the entire payroll journal balances. This structure keeps payroll accounting clean, accurate, and easy to follow. When a debt becomes impossible to collect, we need to remove it from our books. The journal entry achieves three things: recognises the loss to the business, reverses the VAT that was originally charged on the sale, clears the customer balance from the Receivables ledger control account. This is why the entry involves three accounts. When the customer originally bought goods on credit, sales account was credited, value added tax account was credited, and Receivables control account was debited. Now we must reverse the effect on the VAT element, the receivable, and recognise the expense of the bad debt. The journal needs to debit bad debts, which is expense, debit VAT to reduce value added tax liability, and credit Receivables ledger control account to reduce the customer balance. The journal entry debits the bad debts account, VAT account, and credits accounts receivable to write off the unpaid debt, reverse the VAT, and record the loss. Control accounts exist to keep the ledger accurate and easy to check. They take the totals from a group of detailed accounts, whether that's receivables, payables, payroll, or any other area with many individual entries, and summarise them in one place. This makes the system more reliable because you can quickly compare the control account with the underlying records and spot any differences. The result is better accuracy, faster checks, early error detection, and more trustworthy financial reporting. Here is an overview of the main control accounts used in a business. Each control account summarizes information from many individual accounts and gives us one combined figure for the general ledger. For example, the Receivables control account summarizes all customer balances, the Payables control account summarizes what we owe suppliers, and there are similar control accounts for wages, value-added tax, pay-as-you-earn, inventory, and bank. Every control account acts as a summary, and each is used to check the accuracy of the underlying records. We will go through these control accounts one by one so you can see exactly what each of them summarizes, what it checks, and why it's important. The Accounts Receivable control account shows the total amount owed to the business by all customers. It works by collecting the totals from invoices and receipts and summarizing them into one single balance in the general ledger. Let's walk through the process. We start with the source documents. The invoices show how much each customer owes, including value-added tax. Receipt documents show how much they've paid. These then move into the books of prime entry. Invoices are recorded in the sales day book, and customer payments go into the cash book. From there, customer-by-customer details are posted into the accounts receivable ledger. You can see here, customer A now owes £70 and customer B owes £120. At the same time, the general ledger is updated. The revenue account gets the sales value, the value-added tax account gets the VAT, and the receivables control account receives the total amount customers owe. When customers pay, those amounts go to the bank account and reduce the receivables control account. The control account gives us one total figure, in this case £190, which represents everything customers still owe. The key point is that the total of all the customer accounts in the subsidiary ledger must match the closing balance of the receivables control account. If the two do not agree, we know there's an error somewhere. So the receivables control account is a vital check of accuracy and a quick way to confirm all customer balances are correct before we prepare financial statements. Let's look at the specific items that appear inside Accounts Receivables control account. Each line in this table shows a different type of transaction that either increases or decreases the amount owed by customers. The debit side shows anything that increases the amount customers owe. The credit side shows anything that reduces the amount customers owe. Opening balance brought down is the amount customers already owed at the start of the period. It appears on the debit side because accounts receivable is an asset, and assets normally carry debit balances. Any credit sales increase what customers owe. A sale on credit always goes on the debit side of the receivables control account. Returned or bounced checks. If a customer pays but the check bounces, the payment they made was never actually received. So we need to add the amount back to what they owe. If a customer is charged interest for late payment, that interest becomes additional money they owe, so it goes on the debit side. Bank receipts are money received from customers. When they pay, the amount they owe decreases, so this entry appears on the credit side. When customers return goods, we issue credit notes. Their debt must be reduced, so we record the full credit note value on the credit side. If the business gives a discount for early payment, customers owe less, so discounts appear as credits. Bad debts written off is when a customer will never pay. We remove the amount they owe from the control account. This is a credit entry because we reduce the receivable. A contra entry is used when a business is both a customer and a supplier to another company. We offset one balance against the other. If the other company owes us money, but we also owe them money, we can contra the amounts. A contra reduces receivables, therefore it goes on the credit side. Let's walk through a full example of how the Accounts Receivable control account works in practice. At the end of the month, we want to calculate how much money customers owe the business. Here are the transactions for the month. We started with an opening balance of £25,000. That means customers already owed us this amount at the start of the period. During the month, we made £12,000 of credit sales. Those sales increase what customers owe, so this goes on the debit side. A customer's cheque bounced for £600. That means the payment failed, so the customer still owes the money. Customers then made £18,000 of payments. These reduce the amount owed, so they go on the credit side. We issued a £1,000 credit note. This reduces a customer's balance, so that also goes on the credit side. The closing balance on the receivables control account is £18,600 debit. That means customers still owe the business at the end of the month. Let's look at why the total of the receivables ledger might not match the accounts receivable control account. If they don't match, it means something has gone wrong in the posting process, either in the customer accounts or in the control account itself. We'll look at the most common causes of these discrepancies. An invoice is omitted or entered twice. An invoice is overstated or understated. A credit note is omitted or entered twice, or a credit note is overstated or understated. Let's break each one down with simple, clear examples. Let's look at the invoice omitted error. In this example, an invoice for £150 has been recorded correctly in the individual customer's account within the accounts receivable ledger, but it was not posted to the accounts receivable control account. Because the control account is missing this invoice, the ledger total is £150 higher than the control account. This creates a discrepancy between the two records. This type of error is known as an invoice omission. The transaction exists in the ledger but never made it to the control account. Let's look at the invoice entered twice error. In this example, the same invoice for £150 has been entered twice in the accounts receivable ledger, making its balance higher than the control account. This is a classic duplication error in the subsidiary ledger, where a transaction is accidentally entered more than once. Another type of error is overstated invoice. In this example, the invoice should have been recorded at £50, but in the accounts receivable ledger it has been entered as £75. That means the invoice is overstated by £25 in the customer ledger. This creates a difference between the ledger and the control account and is an example of an overstated invoice in the subsidiary ledger. Another type of error is understated invoice. In this example, we have an invoice that should have been recorded at £100, but in the accounts receivable ledger, it has only been entered as £75. This means the invoice has been understated by £25 in the subsidiary ledger. The accounts receivable control account, however, shows the correct figure of £100. Because the invoice was understated in the ledger total ends up being lower than the control account. Next type of error is omitted credit note. In this example, a credit note for £200 has been issued and correctly entered in the accounts receivable ledger. However, it has not been posted to the accounts receivable control account. A credit note reduces the amount owed by the customer. Since the ledger has recorded it, the ledger balance is correctly reduced to £1,000. But because the control account did not record the credit note, its balance remains at £1,200, which is £200 too high. This is an example of a credit note omission from the control account. Next type of error is credit note posted twice. In this example, a credit note for £150 has been issued, and it should reduce the customer's balance only once. However, in the accounts receivable ledger, the credit note has been entered twice. Because a credit note reduces the amount owed, entering it twice means the ledger balance is reduced by £300 instead of the correct £150. Meanwhile, the accounts receivable control account shows the correct posting. The credit note is recorded only once, so the control account is reduced by £150. As a result, the balance in the ledger is £1,000, while the control account stands at £1,150. This is an example of a duplicate credit note error in the subsidiary ledger, where the credit has been posted more than once. Let's summarize what we've learned. Invoices and credit notes can be entered wrongly in either the customer's accounts receivable ledger or the accounts receivable control account, and any difference between the two usually comes from one of these errors. Because invoices make the balance go up and credit notes make the balance go down, the key is simply checking whether the balance has moved too much or not enough. Just like invoices and credit notes, customer payments can be recorded incorrectly, creating a difference between the accounts receivable ledger and the accounts receivable control account. The only principle to remember is, a payment should reduce the amount the customer owes, so any mistake will make the balance either too high or too low. The Payables ledger control account is a summary account in the general ledger that shows the total we owe to all suppliers. It is supported by the Payables ledger or purchase ledger, which contains individual accounts for each supplier. The sum of all supplier balances in the ledger must equal the balance in the control account. Everything starts with source documents, such as supplier invoices, supplier credit notes, payments to suppliers. The purchase invoices flow from the purchase day book into the Payables ledger, and payments flow from the cash book. From the Payables ledger, the totals move into the Payables ledger control account. The Payables ledger control account is part of the general ledger, and it summarizes the total amount the business owes to all suppliers. The key principle here is that the total of all supplier balances in the Payables ledger must equal the balance in the Payables ledger control account. If the two do not match, it means there is an error somewhere in the postings. The Payables ledger control account represents a liability. It normally carries a credit balance. On the credit side, we record anything that increases the amount we owe to suppliers. The main item here is supplier invoices. Every time we buy goods or services on credit, our debt increases. We also include items like interest charged by suppliers or any adjustments that increase the outstanding balance. On the debit side, we record everything that reduces the amount we owe. This includes payments to suppliers, supplier credit notes, purchase returns, and discounts received. Any transaction that decreases our liability goes on the debit side. By the end of the period, the credit side minus the debit side leaves us with a closing credit balance. That closing balance represents the total amount still owed to all suppliers. Most importantly, this closing balance must match the total of all supplier accounts in the Payables ledger. If the two figures don't agree, we know that a posting error has occurred and a reconciliation is required. Let's walk through a simple example of how entries appear in the Accounts Payable control account. Imagine that at the start of the month, the business already owes its suppliers £12,000. This opening balance goes on the credit side because it represents a liability brought forward. During the month, the business receives new supplier invoices worth £5,000. These invoices increase what we owe, so they are also entered on the credit side. We were also charged £200 interest by one of our suppliers for late payment. This is an additional liability, so it increases the credit side as well. Now let's look at the debit side, which reduces the balance owed. We made payments to suppliers totaling £3,500. Payments reduce what we owe, so they appear on the debit side. One supplier issued a credit note for £400 because some goods were returned. That also reduces our liability, so it goes on the debit side. We also received £100 in early payment discounts. Since discounts reduce the amount payable, they are entered on the debit side as well. Finally, we recorded a contra entry of £300 with a customer who is also a supplier, meaning we offset their balances rather than paying them separately. This reduces the amount payable, so it also appears on the debit side. When we total the debits and credits, the balance carried down will show how much the business still owes its suppliers at the end of the period. And of course, this closing balance must match the total balance in the Payables ledger. The types of errors you can make in the Accounts Payable ledger and the Accounts Payable control account are very similar to those in Accounts Receivable. It can be omitted invoices and credit notes, duplicates, understated or overstated amounts. The only difference is that accounts payable is a liability, so the invoices increase the amount owed and payments reduce it. The tables here follow the same pattern you already learned in accounts receivable, just applied to suppliers instead of customers. Invoice omitted error is when a purchase invoice wasn't entered at all, so the liability doesn't increase. Accounts payable balance is too low. Invoice duplicated error is when posting the same invoice twice increased the balance twice. Balance in this case is too high. Invoice understated error is when the invoice was recorded for too little. In that case, balance is too low. Invoice overstated is when the invoice amount was entered too high. Liability increased too much. Balance is too high. Credit note omitted error is when a supplier credit note wasn't recorded, so the liability doesn't fall. Balance is too high. Credit note duplicated error is when the credit note was entered twice, reducing the balance twice, so the balance is too low. Credit note understated is when a credit note recorded for less than it should be. Liability decreases too little. Balance is too high. Credit note overstated error is when a credit note recorded for higher amount. Liability decreases. Balance is too low. Let's now look at the common errors that can cause differences between the purchase ledger and the accounts payable control account. In this example, we have an omitted invoice error. An invoice for £150 was entered in the purchase ledger but not entered in the accounts payable control account. This means the purchase ledger shows the full amount owed. This error can actually occur on either side, in the purchase ledger or in the control account, because these two records are updated separately. This is a duplicated invoice error. The £150 invoice was entered twice in the purchase ledger but posted correctly in the accounts payable control account. So the purchase ledger total becomes £1,300, while the control account is correctly showing £1,150. In this example, the invoice was understated in the purchase ledger. It should have been £150, but only £100 was recorded. The control account has the correct value. Any understated invoice entry makes the balance too low. Here, the purchase ledger has an overstated invoice. Instead of £150, it was entered £200. The control account is correctly showing £1,150. An overstated invoice always makes the ledger too high. Here, a £100 credit note has been omitted from the accounts payable control account. The purchase ledger correctly reduces the balance to £900. But the control account still shows £1,000 because the credit note wasn't recorded. The control account balance becomes too high compared to the ledger. This error shows a duplicated credit note. The purchase ledger has reduced the balance by £100 twice. The control account only reduced it once, so it has correct balance. Duplicating a credit note always reduces the balance too much. Here the credit note was overstated in the ledger. Instead of recording a £100 credit, £150 was recorded. This reduces the ledger to £850, while the control account remains at £900. An overstated credit note made the purchase ledger too low. In this example, the credit note has been understated in the purchase ledger. Only £50 was entered instead of the correct £100. This means the ledger only reduces to £950, but the control account correctly reduces to £900. An understated credit note makes the purchase ledger too high. In this example, the payment was entered in the purchase ledger, but completely missed in the control account. The ledger correctly reduces by £50 to £1,950, but the control account still shows £2,000. Whenever a payment is omitted from the control account becomes too high compared to the ledger. Here the payment has been entered twice in the purchase ledger, but once in the control account. The ledger reduces by £100 instead of £50, giving £1,900, while the control account reduces by £50. Duplicating a payment makes the purchase ledger too low compared to the control account. In this case, the payment was recorded correctly in the control account at £50, but in the purchase ledger, only £20 was entered. So the ledger reduces too little, showing £1,980, while the control account shows the correct balance. An understated payment causes the purchase ledger to be too high. Here, the opposite has happened. The ledger shows overstated payment of £80 instead of the correct £50. The ledger reduces too much to £1,920, while the control account shows the correct balance. An overstated payment makes the purchase ledger too low compared to the control account. VAT, or Value Added Tax, is a tax applied to most goods and services sold by VAT-registered businesses in the UK. It's a consumption tax, meaning it's ultimately paid by the end consumer. Businesses collect value-added tax on behalf of HMRC. A business must register for VAT if its taxable turnover goes over the VAT registration threshold, currently £90,000 per year, but always check HMRC for the latest figure. It expects its turnover to exceed this threshold within the next 30 days. Businesses can also register voluntarily even if they're below the threshold. For example, if they want to reclaim VAT on purchases or appear more established to other VAT-registered businesses. Output value added tax is the VAT a business charges on its sales to customers. For example, if a business sells goods for £100 and the VAT rate is 20%, the customer pays £120 in total. The output value added tax is £20. Input value added tax is the VAT a business pays on its purchases from suppliers. For instance, if the business buys materials for £50 plus 20% VAT, it pays £60 in total. The input value added tax is £10. How value added tax works. Businesses don't pay all the value added tax they collect. Instead, they pay HMRC the difference between value added tax they charge and the VAT they've already paid. In simple terms, output VAT minus input VAT equals value added tax payable or reclaimable. If output value added tax is greater than input VAT, the business pays the difference to HMRC. If input value added tax is greater than output VAT, the business can reclaim the difference from HMRC. Now let's look at how value-added tax appears in our accounting day books, specifically the Sales Day Book and the Purchases Day Book. Remember, the Sales Day Book records all credit sales to customers, while the Purchases Day Book records all credit purchases from suppliers. In the Sales Day Book, we record the value-added tax we charge on our sales. This is called output VAT. For example, on the 4th of January, Bright Home Interiors bought goods worth £850. VAT at 20% is £170, giving a total of £1,020. When we add up all the sales for the period, we get net sales, £2,445, value added tax charged, £489, total sales, £2,934, £489 of VAT doesn't belong to us. It's money we've collected on behalf of HMRC. Next, in the Purchases Day Book, we record the value-added tax we've paid to suppliers. This is called input VAT. For example, on the 3rd of January, we bought goods from Office Pro Supplies for £620. Value-added tax at 20% is £124, making the total £744. At the end of the period, we total it up. Net purchases is £1,365. VAT paid, £273. Total purchases is £1,638. This £273 of input value added tax can usually be reclaimed from HMRC. Let's look at double entry for value-added tax. When a business makes a credit sale, it charges VAT to the customer. That's our output value-added tax. Double entries are debit accounts receivable £2,934. This is what customers owe. Credit revenue account £2,445. This records the sale itself. Credit VAT on sales £489. This is the VAT we've collected on behalf of HMRC. So, output VAT increases our liability to HMRC because we've collected tax from customers. Now let's look at input value added tax. Double entries are credit accounts payable £1,638, what we owe suppliers. Debit expenses or purchases £1,365, for the cost of goods and services. Debit VAT on purchases £273, because we can reclaim this from HMRC. So, input value added tax increases our recoverable amount from HMRC. When we prepare our VAT return, we compare output value added tax from the sales day book, £489, £273, input VAT from the purchases day book. We then pay HMRC the difference, £216, which is £489 minus £273. Next, we're going to look in more detail at what exactly goes on each side of the value-added tax control account, where those figures come from in the bookkeeping process, and how the account is built up from our day books and cash book. This table shows the exact sources from which VAT amounts are transferred into the value-added tax control account. Notice how the VAT from the credit side of the cash book appears as a debit in the VAT control account. That's because cash going out generally relates to input VAT, and value-added tax from the debit side of the cash book goes on the credit side here because money received normally relates to output VAT. Let's look at input value-added tax. First is value-added tax paid to HMRC. We record this on the debit side of the VAT control account. The reason is that the value-added tax payment reduces the liability that previously existed on the credit side of the account. So we debit control account in order to reduce that credit balance. Next is VAT on purchases, which is posted to the debit side because it can be reclaimed from HMRC on the value-added tax return. VAT on expenses is when the business also pays VAT on day-to-day expenses such as stationery and other overheads. These are treated the same way as purchases for VAT purposes. VAT on sales returns is when a customer returns goods, we may need to refund part of the sale, including the VAT that we originally charged. This reduces the amount of value-added tax that we owe to HMRC. VAT on discounts allowed is when we offer a discount to a customer. The VAT element of that discount reduces the amount of VAT we need to pay over. Let's look at the credit side of output value-added tax. First is VAT refund received from HMRC. Value-added tax on sales is tax that we have collected from customers on behalf of HMRC, and therefore it is recorded on the credit side because it represents a liability owed to HMRC. Next is value-added tax on purchases returns. If we return goods to a supplier, we no longer need to reclaim the VAT on those goods. Value-added tax on discounts are received from suppliers. This element reduces the amount of VAT we are allowed to reclaim. In summary, the debit side of the value-added tax control account represents VAT we have paid and may reclaim, and the credit side represents VAT we have collected and may owe to HMRC. Each item either increases or reduces that input or output value-added tax position, and that's why it appears on the side it does. Businesses above the VAT threshold must submit VAT returns digitally. Software like QuickBooks, NetSuite, Sage record VAT and send reports directly to HMRC. There are 5 key value-added tax categories we need to know. Let's go through them briefly. 20% standard VAT rate. This is the main rate, currently 20%. and it applies to most goods and services. Next is the reduced rate at 5%. This applies to certain specific goods or services, for example, domestic fuel and power, children's car seats, or energy-saving materials, as long as the HMRC conditions are met. Then we have the zero rate. These goods are still part of the value-added tax system, but the rate is zero. That means you don't charge VAT. Examples include children's clothing, most food, and exports. Next is exempt from value-added tax. Some goods and services are completely exempt, which means no VAT is charged at all. These include things like certain education, healthcare, insurance, and financial services. And finally, we've got outside the scope. These are things completely outside the VAT system, so there's no value-added tax to charge and none to reclaim. Examples include salaries, donations, dividends, and certain payments to government authorities. Let's wrap up with a quick summary of what we've covered about value-added tax. VAT is a tax on most goods and services. It's collected by VAT-registered businesses on behalf of HMRC. Those businesses charge value-added tax on their sales. That's output VAT, and they can reclaim VAT on their purchases. That's input value-added tax. VAT appears in both the daybooks and in double-entry bookkeeping, so it affects the accounting records directly. Always make sure to separate the net amount, the VAT amount, and the gross total. That's essential for accurate recording. And finally, value-added tax must be recorded and reported correctly, especially now under Making Tax Digital, which means using approved digital systems for submissions. Inventory is classed as a current asset, which means it's something the business expects to sell or use within the next 12 months. Essentially, inventory includes all the goods a business holds for the purpose of selling or using in production. This could be boxes of products sitting in a warehouse, items being counted in the stockroom, or goods arriving on a delivery truck. The key point is, inventory is not just physical stock. It represents money tied up in goods the business intends to convert into sales. Inventory can actually come in different forms depending on the type of business. Raw materials are the basic components used to create a finished product, like fabric and other ingredients. Work in progress, often called WIP, includes items that are partially completed. These are not ready for sale yet, but have already had some labour or production costs added. Finished goods are the completed items that are ready to sell to customers. Inventory has a major impact on several areas of the business. First, it affects profit. When a business sells goods, the value of inventory becomes an expense called cost of goods sold. The higher the cost of goods sold, the lower the profit. It also affects cash flow, because buying too much inventory ties up cash that could have been used elsewhere. Inventory is a big part of working capital, which tells us how much short-term resource the business has. It directly affects the cost of goods sold calculation, which we'll look at later. And finally, inventory affects business valuation. So inventory isn't just a number. It influences the overall financial health of the business. Now let's look at one of the most important rules in inventory accounting. Under accounting standards, inventory must always be valued at the lower of cost and net realizable value, known as NRV. NRV is simply the selling price minus any costs required to make the sale. These can include packaging, delivery to the customer, or sales commission. The reason we use the lower figure is to follow the principle of prudence. If inventory has fallen in value, perhaps due to damage, expiry, or lower demand, we cannot overstate its worth. So if NRV is lower than cost, the inventory must be written down. This ensures that the financial statements reflect a realistic value of stock. Now that we understand what inventory is and how it must be valued, the next question is, how do we actually calculate the cost of our inventory? There are three commonly used methods: The first is FIFO, first in, first out. Here, we assume the earliest goods purchased are the first ones to be sold. This means the stock left at the end of the period is valued at the most recent prices. The second method is AVCO, average cost. This takes the total cost of all inventory purchased and divides it by the total units, giving an average cost per item. The third method is LIFO, last in, first out, where the most recently bought items are assumed to be sold first. It's important to note that LIFO is not allowed under IFRS, but you may still see it in some countries. These methods affect profit, closing inventory value, and your financial statements differently, so choosing the right method is crucial. Let's look at how inventory movements are recorded. When inventory is purchased on credit, we debit the inventory account because the amount of stock we hold increases. We credit trade payables because we now owe money to suppliers. At the end of the period, we adjust inventory to calculate the cost of sales. The formula is opening inventory plus purchases minus closing inventory equals cost of sales. This cost of sales figure is the amount transferred into the profit and loss account as an expense. So inventory movements impact both the balance sheet and the profit and loss. In the statement of profit or loss, the cost of sales figure is shown as an expense. Sales minus cost of sales gives the business its gross profit. In the statement of financial position, which is the balance sheet, the closing inventory figure is shown under current assets. This is the value of the stock the business still holds at the end of the period, valued using the lower of cost and net realizable value, and calculated using a costing method like FIFO or AVCO. So inventory impacts both major financial statements and plays a significant role in measuring profitability and financial position. Let's look at how to calculate inventory values using the FIFO method, first in, first out. FIFO assumes that the earliest units purchased are the first ones to be sold. So the flow of costs reflects the actual physical flow of many businesses, especially those handling perishable or fast-moving stock. At the start of the period, the business has 50 units in opening inventory at £40 each. During the period, they purchase 30 units at £42 and another 40 units at £44. That gives a total of 120 units available for sale. We then assume that 60 units have been sold. FIFO means we start allocating cost from the oldest stock. The first 50 units sold come from the opening inventory at £40, and the next 10 units come from the first purchase at £42. This gives us a cost of goods sold, or COGS, of £2,420, which will be taken to the profit and loss account as an expense. The remaining units form our closing inventory. We use 10 of the 30 units purchased at £42, so 20 remain, and none of the second purchase has been used, so we still have all 40 units at £44. That gives a closing inventory value of £2,600, which is shown as a current asset on the balance sheet. So to summarise, FIFO gives us a COGS of £2,420 that goes to the P&L, and a closing inventory of £2,600 that goes to the balance sheet. This slide shows how the FIFO calculations flow through the accounts using T accounts and financial statements. Let's start with the inventory T account. We begin with an opening balance of £2,000, which represents the value of inventory at the start of the period. That's 50 units at £40. During the period, the business purchases additional stock worth £3,020. Both of these are debited to the inventory account because we are increasing an asset. At the end of the period, we transfer the cost of the units sold, £2,420, out of inventory and into the cost of sales account. This reduces the inventory balance. What remains is the closing balance of £2,600, which will appear in the balance sheet as a current asset. Now looking at the cost of sales T account, you can see the £2,420 being debited from inventory. This becomes the cost of goods sold in the profit and loss statement. In the P&L, we have revenue of £5,500, COGS of £2,420, leaving a gross profit of £3,080. Finally, in the balance sheet shows the closing inventory of £2,600 within current assets. This represents the value of the goods the business still holds at the end of the period, valued using FIFO and the lower of cost and NRV rule. FIFO affects both major financial statements. It determines the cost of sales in the P&L, and it determines the value of inventory in the balance sheet. The T accounts help demonstrate the movement of inventory through the accounting system and show how opening inventory, purchases, COGS, and closing inventory all link together. Let's look at how to apply the Net Realizable Value test, which is required by International Accounting Standard 2. ABC Limited produces electronic headphones. At the end of the period, we need to check whether the inventory is valued correctly. International Accounting Standard 2 tells us that inventory must be valued at the lower of cost and net realizable value. And this is a key rule in financial reporting. The selling price per unit is £55, and the business will incur £3 of costs to sell each unit. This might include packaging, delivery, commission, or other selling costs. So the net realizable value per unit is £55 minus £3, which is £52. For the 60 units we have in closing inventory, the total net realizable value is £3,120. We then compare this net realizable value figure to the cost of closing inventory, which we previously calculated using FIFO. The first-in, first-out valuation gave us a closing inventory cost of £2,600. Because International Accounting Standard 2 requires us to take the lower of the two values, we keep the inventory at £2,600. The net realizable value is higher in this case, so there is no write-down and the inventory remains at cost. This figure, £2,600, is what appears in the balance sheet under current assets. So after calculating cost using a costing method like FIFO, we must always apply the net realizable value test to ensure inventory is not overstated. Now let's look at the inventory control account. The purpose of this account is to record all movements in inventory at cost, not at selling price. This aligns with International Accounting Standard 2, which requires that inventory is measured at cost unless net realizable value is lower. Inventory is an asset, so increases in inventory are recorded on the debit side, and decreases are recorded on the credit side. We start with the opening balance brought down from the previous period. This is the value of the inventory the business already had at the start of the period. Since inventory is an asset, opening inventory appears as a debit balance. Purchases represent goods bought for resale or for use in production. Because these goods are added to stock, they increase the inventory balance and are therefore recorded on the debit side. Carriage inwards, also called freight in, is added to the cost of bringing inventory into the business. Delivery costs directly attributable to inventory form part of its cost. Because it increases inventory value, carriage inwards is also debited. When goods are returned by customers, we must reverse the original cost entry because the goods are now back in stock. Reversal of cost of sales for sales returns. We return inventory at cost, not at selling price. We record decreases in inventory on a credit side. Transfer to cost of sales, COGS. It's the biggest credit entry is the transfer to cost of sales. This represents the value of inventory that has been sold during the period. Once it's sold, it is no longer an asset, so we credit inventory and debit cost of sales. This is the same figure you later see in the profit and loss statement. Purchase returns, also known as returns outwards, are goods that we return to our suppliers. Because these items leave our inventory, we reduce the asset by crediting the inventory control account. Abnormal losses. If inventory is damaged, stolen, expired, or otherwise unsellable, it must be written off. These abnormal losses reduce the amount of usable inventory, so they are recorded as credits. This ensures inventory is not overstated. Closing inventory. At the end of the accounting period, we calculate the closing inventory value. normally using first in, first out or average cost. Closing inventory appears as a credit balance carried down because it represents the portion of the asset that remains. In the next period, this becomes the new opening inventory and moves to the debit side. Every transaction we record has two sides, one debit and one credit. Over time, dozens or even hundreds of entries are posted into the ledger. But how do you make sure everything has been entered correctly? That's where the trial balance comes in. A trial balance is a list of all the balances in the general ledger at a particular date. It is one of the key checkpoints in bookkeeping, helping us confirm that our entries follow the double entry rules. The trial balance is generated to, first, provide an overview of all account balances. It shows the balance of every account, assets, liabilities, capital, equity, revenue, other income, expenses, and drawings, all in one place. Second, check mathematical accuracy. If total debits equal total credits, it suggests the arithmetic is correct. Third, help identify mistakes. If the totals do not agree, an error has likely occurred in the bookkeeping process. And fourth, prepare for financial statements. Businesses rely on an accurate trial balance to produce income statement, called profit and loss, and balance sheet, called statement of financial position. A trial balance acts like a bridge between the ledger and the financial statements. Before we build a trial balance, we must understand how ledger entries are created. This takes us to the duality principle. It's the rule that keeps our books balanced and is the heart of double entry bookkeeping. In accounting, every financial transaction is recorded using double entry, and all accounts fall into 5 main categories: assets, liabilities, capital and equity, expenses and revenue. These categories determine whether an item is debited or credited. The duality principle tells us that every transaction has two sides. To record these, we use double entry bookkeeping. One account is debited and one account is credited, and the total debits must always equal the total credits. Whether a debit or credit means an increase or decrease depends entirely on the type of account. Transactions can fall into 4 different duality patterns. First duality pattern is increase on both sides. For an example, the business buys equipment worth £2,000 on 30-day credit. Equipment, which is an asset, increases, debit £2,000. Trade payables, which is liability, increases, credit £2,000. Both sides of the accounting equation increase. An asset rises and a liability rises, but debits still equal credits. Second duality pattern is decrease on both sides. For an example, the business repays £500 of a bank loan. Bank, which is an asset, decreases, credit £500, and loan payable, which is liability, decreases, debit £500. So here we have both sides decreasing. The asset goes down because cash is paid, and the liability goes down because the loan is reduced. Third duality pattern is increase and decrease on the same side. For an example, business sells old equipment for £150. Bank, which is an asset, increases, debit £150, and equipment, which is an asset as well, decreases, credit £150. In this case, both entries sit under assets, so only one side of the accounting equation is affected. One asset rises, another falls, and the books still balance. And fourth duality pattern is increase on one side and decrease on the other. It happens when we pay for something or when money leaves one part of the business and becomes something else. For an example, business pays a rent expense of £300. Rent expense increases, debit £300, and bank, which is an asset, decreases, credit £300. By following the accounting equation and the debit-credit rules, we keep financial records accurate and balanced. Now let's practice how all of this looks in real accounts. We'll post the transactions into T accounts and then bring them together in a trial balance to check that everything adds up. Imagine we're looking at a few real documents, an invoice, a supplier bills, and some bank transactions. These are everyday business events. Our job is to turn them into accounting entries. The plan is, first, we'll take each transaction and decide which accounts it affects. Second, we'll record it into our T accounts. Third, we'll total everything up and check that our trial balance still balances. Basically, we're turning business paperwork into balanced numbers. Our first transaction, the owner puts £10,000 cash into the business. Which two accounts are involved? Bank and owner's capital. Let's post that in our T accounts. The bank increases, so we debit bank. Capital increases, so we credit capital. Next, the business takes out a £50,000 loan from the bank. That increases our bank, so debit bank. This increases our loan, which is liability account, credit loan. Then we buy computers for £9,600, including £1,600 VAT. So, debit computers £8,000, asset account. Debit VAT on purchases £1,600. And credit bank £9,600, asset account. We paid for our office supplies £500, so our double entry will be debit office supplies £500 because our expense increased, and credit bank £500 because our cash decreased. Office supplies is an expense, and expenses always increase on the debit side. The bank account is an asset, and assets decrease on the credit side when we spend money. Now, let's look at another transaction. The business received £2,000 for services we've provided, and the money went straight into the bank account. The bank account is an asset, and assets increase on the debit side when money comes in. The service revenue account represents our revenue, and revenue increases on the credit side. Debit bank £2,000 because cash in the bank increased, and credit revenue account £2,000 because our revenue increased. Let's look at this transaction. Our client has paid £5,400 for an invoice we issued earlier for software we provided. The money is received into our bank account. Our accounts receivable decreases because the customer has now paid what they owed. Assets decrease on the credit side. Our bank account increases because cash came in. Assets increase on the debit side. Let's look at the utilities and rent payments. Business paid £300 for utilities and £1,200 was paid for rent. Both reduce the bank balance, so they appear on the credit side. Utilities is an expense, and expenses always increase on the debit side. So the £300 payment is shown as a debit in the utilities account. The same applies to the rent account. Rent is also an expense, so the £1,200 payment is recorded as a debit in the rent account. This shows the double entry principle in action. Each transaction appears twice: a credit in the bank account and a debit in the relevant expense account. Now that we've posted our transactions into T accounts, let's bring everything together in one place. This table is the general journal. It shows every debit and credit from all the accounts we used. When we list all the debits and credits together like this, the total debits must equal the total credits. This is a quick way to check that our double entry work is correct. To make it clear, we'll use the bank account as our example, since it has several transactions and is ideal for showing the balancing process. First, we total both sides of the account, all the debits and all the credits. Then, we calculate the difference between them. The total on the debit side is £67,400 and the total on the credit side is £11,600. The difference between them is £55,800. It's the balance that needs to be entered into the bank account to make both sides equal. The difference is what we call the balance carried down. This is entered on the side with the smaller total, so that both sides equal the same amount. Finally, we bring that balance forward to the next period. This is the balance brought down. It appears on the opposite side to where the balance carried down was entered. If the balance brought down appears on the debit side, it means the account has a debit balance. In this case, the business has money in the bank. If it appears on the credit side, it would mean the account is overdrawn. Balancing accounts manually helps us check the accuracy of our entries before moving on to the trial balance, which summarizes all our accounts at period end. Now that we've balanced the accounts, we can take the closing balances and record them in a trial balance. The trial balance shows all the account balances at a point in time. In this case, after we've balanced the bank account. Each account appears once, with its closing balance shown on either the debit or credit side, depending on the account type. The total of the debit column should always equal the total of the credit column. If they don't, it means there's likely an error somewhere in the entries or calculations. The trial balance acts as a check for accuracy, making sure that every transaction has been recorded with equal debits and credits. Although it gives a snapshot of the accounts, its main purpose is to confirm that the bookkeeping is mathematically correct before moving on to preparing financial statements. Now that we know how the trial balance is prepared, the next step is understanding what can go wrong. Before we can correct mistakes, we first need to understand the different types of errors that can occur in accounting records. First type of error is reversal of entries. This happens when the correct accounts are used, but the debit and credit are swapped. For an example, we bought equipment for £1,000. Correct entry should be debit equipment £1,000 and credit cash £1,000. But the wrong entry was posted as debit cash £1,000 and credit equipment £1,000. The accounts are correct, cash and equipment, but the sides are reversed. Why this matters? The trial balance still balances, which makes the error harder to detect. However, the financial statements are wrong because the accounts show the wrong direction of movement. We have to correct a reversal of entries error. The correction has two stages. Step 1. Remove or reverse the incorrect entry by simply doing the opposite. Debit equipment £1,000 and credit cash £1,000. This cancels out the mistake and returns both accounts to where they would have been if nothing had been posted. Step 2. Post the correct entry. Correct entry should be debit equipment £1,000 and credit cash £1,000. We do it in 2 steps because a reversal error means the original entry is backward, so we must undo what was done and record what should have been recorded. Removing the original mistake ensures the accounts reflect the true position. Second type of error is error of original entry. Error of original entry is when the wrong figure is recorded from the very beginning. An error of original entry happens when the correct accounts are used, but the amount itself is written incorrectly when the transaction is first entered in the books. This means the mistake starts at the source. For example, the invoice, receipt, or instruction was read incorrectly or mistyped. Once the wrong figure is entered, that same wrong figure gets posted throughout the accounting system. For an example, the business was meant to record £12,500, but the amount was mistakenly recorded as £1,250. The transaction is still between the correct accounts, but the value is wrong. Corrections follow a very logical process. Step 1. Reverse the incorrect entry. We post the opposite. Debit bank £1,250 and credit rent expenses £1,250. Step 2. Post the correct entry. Now enter the transaction with the right amount. Debit rent expenses £12,500 and credit bank £12,500. This 2-step method clears the books of the incorrect figure entirely. It makes the correction transparent and easy to audit. Next type of error is error of principal. When a transaction is posted to the wrong type or class of account, an error of principal occurs. The amount is correct, but it is posted to the wrong type of account. This breaks accounting principles. The trial balance still balances, but the financial statements become misleading. For an example, the business pays £400 for office stationery, like pens and paper, but the bookkeeper accidentally posted it as if the business had bought a new office desk, which is a non-current asset. Wrong entry was made, debit office furniture £400, which is a wrong type of account. The amount is correct, £400 was paid, but it was posted to the wrong category of account. To correct this error, we will remove the incorrect entry and post the correct entry. Since bank is correct, we don't reverse the whole entry. We simply credit office furniture £400 and debit stationery expense £400. Bank remains untouched because it was correct. We fixed only what was posted incorrectly. Next type of error is error of commission. Error of commission is when the entry is posted to the correct type of account, but to the wrong specific account within that category. The amount is correct, the debit and credit direction is correct, but the bookkeeper chooses the wrong actual account. Simple example, the business pays £150 for cleaning supplies. Correct expense account is cleaning expense, but the bookkeeper accidentally posts it to postage expense. Wrong entry made, debit postage expense £150, credit bank £150. Bank entry is correct. The only problem is the wrong expense account was used. We don't need to reverse the whole entry. We only fix the wrong expense account, credit postage expense and debit cleaning expense. Next type of error is error of omission. Error of omission is when a transaction is completely left out of the accounting records. Nothing is entered in any ledger. Because both debit and credit are missing, the trial balance still balances, making the error harder to detect. For an example, sales invoice omitted. A sales invoice is issued to a customer, ABC Limited. Net amount is £1,000, VAT £200, total is £1,200. Correct entry should have been debit trade receivables £1,200, credit sales £1,000, and credit VAT output £200, but the invoice was never entered in the accounts. This means ABC Limited shows no amount owed, sales are understated, VAT return is incorrect, profit is understated. How to correct an error of omission? Since nothing was entered, there is nothing to reverse. We simply need to post the correct entry in full, as if doing it for the first time. Debit trade receivables, £1,200, credit sales £1,000, credit VAT output £200. Another type of error is compensating error. A compensating error occurs when two separate errors happen in the accounts, but they offset each other, so the trial balance still balances. Individually, each error is wrong, but because one error increases or decreases the total on one side and another error increases or decreases the total on the opposite side by the same amount, the trial balance appears correct, even though the underlying accounts are not. These errors mask each other and make the books look right when they are not. Let's look at two unrelated errors. Error 1. Electricity expense was supposed to be £300, but the bookkeeper posted £200. The debit side is understated by £100. Error 2. Sales revenue was supposed to be £5,000, but only £4,900 was recorded. The credit side is understated by £100. Result of these, debit is £100 too low and credit is £100 too low. They cancel each other. Trial balance still agrees. To correct the understated electricity expense and sales, we debit electricity expense £100 and credit sales £100. Let's summarise the 6 types of errors that do not affect the trial balance. Even though these errors are all different, they have one important thing in common. The debits and credits still add up to the same total, which means the trial balance will still balance, even though the accounts are wrong. Error of omission. The whole transaction is simply missing. Nothing was posted at all. Error of commission. The right type of account was used, but the wrong specific account, such as choosing the wrong expense account. Error of principle. The transaction went to the wrong category of account, for example, treating an expense as an asset. Error of original entry. The correct accounts were used, but with the wrong amount. Reversal of entries. The accounts are correct, but the debit and credit have been posted on the wrong sides. Compensating errors. Two completely separate errors happen, but they cancel each other out, so the trial balance still balances. These are the key errors that don't impact the trial balance, which is why we can't rely on a balanced trial balance to mean everything is correct. A trial balance can agree, but the accounts may still contain mistakes. There are a few types of errors that affect the trial balance. These are older, manual bookkeeping errors. Modern systems normally prevent them, but you still need to recognize them because they explain why a suspense account may appear. A suspense account is used temporarily when the trial balance doesn't balance, holding the difference until the errors are found and corrected. Now let's start with real business transactions and see how they move through the accounting system. These are the day-to-day events that affect the business financially, such as the owner investing capital, buying equipment or inventory, selling goods, paying suppliers, paying wages, and paying rent. At this stage, we are not preparing financial statements yet. We are identifying what happened and which accounts are affected. Let's record each transaction in the general ledger using T accounts. Each T account represents one ledger account. Assets increase on the debit side, liabilities and equity increase on the credit side. Expenses are debited, revenue and income are credited. In our example, owner's capital increases the bank, debit, and capital, credit. Paying suppliers decrease bank, credit, and decrease trade payables, debit. Buying inventory and equipment on credit increase trade payables, credit, and increase inventory, debit, and increase equipment, debit. Paying rent decrease bank account, credit, and increase rent expense, debit. Selling goods to customers on credit increase trade receivables, debit, and increase revenue, credit. Gross wages and employers' pension contribution are companies' expenses. Wages, tax, and pension contributions are companies' liabilities. When all transactions are posted, each T account is balanced. We calculate the closing balance. Once all ledger accounts are balanced, we prepare a trial balance. The trial balance is a list of all ledger balances, split into debit balances and credit balances. Its purpose is to check that total debits equal total credits. If they agree, it confirms the double entry has been applied correctly, but it does not guarantee the accounts are error-free, but it gives us confidence to move forward. Our trial balance now becomes the bridge between bookkeeping and financial statements. Now we separate performance from position. From the trial balance, we extract income and expenses only. In our example, revenue is £12,000. COGS is £0. Gross profit equals £12,000. Then we deduct admin expenses, wages expense and rent expense. This gives us operating profit. Corporation tax is 0 in our study case. We are not going through corporation tax calculation at this level. The result is net profit for the period. Finally, we prepare the balance sheet, which shows the business position at a point in time. The balance sheet answers what the business owns and what it owes at the end of the period. Our balance sheet correctly shows assets. It includes equipment, bank, inventory, trade receivables. Liabilities are trade payables, pension payable, wages tax payable. Equity includes owner's capital plus retained earnings. The net profit from the P&L is transferred to retained earnings. This is the link between the P&L and the balance sheet. So to summarize the full flow, transactions happen in the business. Transactions are recorded in T accounts. T account balances form the trial balance. The trial balance feeds into the statement of profit or loss and the balance sheet.